Hi everyone. Thank you for coming. Thank you for coming to Western Gate today. Appreciate your time this morning. Hope you enjoyed the little breakfast snacks. I'm going to introduce you to Nick Whitten, our head of residential research, who's going to give you an overview of the market and also give you a preview of our residential forecasts. So Nick, I'm going to hand it over to you.
Thank you, Alex. Thank you. Good morning, everyone. It's a great pleasure for me to be able to speak with you. What a lovely space to be able to do a market presentation in. This is not normal fare, and obviously in recent years, past 2 years, it's been very different when I've been sat in front of my screen at home, looking up from the screen and seeing a white wall. So it's nice to see faces. It's great. Today I'm going to run you through how the market has been performing, the residential market, and then, as Alex says, we've got an exclusive look at our new market forecasts for you today. These forecasts are due out any time now. We're in the process of preparing to publish, but right now they haven't been published, so you'll get a look at them for the first time today. So first of all, I just want to take you through what we've been going through over the past 2 years, and obviously it's been quite an incredible period in terms of how the housing market has performed. If you look at this chart in front of you here and trace yourself to around about where it says April 20 towards the right-hand side of the chart, you would have expected at that point, given the events that occurred around COVID-19, to probably have seen something like the inverse of what we see in terms of what the red line then did. Many forecasters, ourselves included, actually expected quite a sharp contraction in terms of house price change. So we expected steep falls. We predicted, in fact, something like 9% fall in UK house prices, and many of our peers at different consultancies had similar outlooks. Obviously, what then occurred defied what's happened in all previous recessions since. For the first time in history, the housing market decoupled from the performance of the economy, and we actually saw strong price growth. And that's because 2 or 3 key reasons. Number one, the government support that was put in to protect the economy and in turn to protect households meant that we saw very little distress in the market. Normally distress leads to contraction in house prices, but there's been very few distressed households because of the job protection schemes. Secondly, the stamp duty holiday, that served to give a little bit of a kicker in terms of boosting demand and pushing activity through. So that helped to create further activity. And then thirdly, across the broad housing market across the UK and indeed much of the Western world, people's living priorities have slightly altered around what they want from their homes. They've taken a real good look at those homes, hadn't been forced to spend so much time in them, and decided what was really important to them, and that in turn has led to a real kicker in terms of activity. Now in terms of that activity, looking at that in a bit more detail, this slide shows you housing transactions across the UK. The grey bars are on a monthly basis and the red line is the annual number of transactions to date. And so a few quick headlines to draw from this. First of all, the spikes. I love a spike on a chart, and there are 2 really good spikes towards the right-hand side there in terms of monthly transactional activity in the UK. First of all, a record was set in March 2021 for the number of transactions in a single month, and that was because of people trying to get in before the end of the stamp duty holiday in the mainstream market. But then that record was exceeded thereafter in June 2021, where for the first time in a single month we had sales go above 200,000. Overall, we're looking at probably finishing the year of something in the order of 1.5 million sales in the UK, which will be the first time we've seen that number of sales since before the global financial crisis. Now, why have we got so many sales? So some of the reasons we've outlined as to how people felt effectively distress was kept out of the market and people felt more secure in their situation. What's really driving the behaviour is essentially mortgaged households who are probably typically fulfilling a profile of young families or young professional families. There are around about 10 million of those types of households in the UK. And at any one time, we believe that if you've got about 10% of those households looking to move, that is going to drive the bulk of the normal seasonal annual transactions that you would expect to see. So right now, we've definitely got 10% of people considering whether they want to move. These people that we're describing, these young professional households, have seen some equity growth over the past 10 years in terms of their house has increased in value. They've seen solid wage growth in recent periods, and crucially, they can access an incredibly low cost of borrowing. Mortgage rates are available now, obviously, in the low 1% on a 5-year fixed basis. This is helping persuade these households to move, and this is in turn is driving the whole market in terms of the performance we're seeing. Now, if you want to just get a flavour of exactly how that sort of cocktail of scenarios does drive behaviour, and particularly considering the stamp duty holiday that's been a real feature of the market, this chart's quite pretty good compelling evidence for that. This shows you the number of days it's taking for buyers to complete a sale from the moment of an offer having been accepted. And pre-COVID, it was taking 65, 70 days for that process to occur. Post-COVID, and particularly in the period since the stamp duty holiday has been available, the number of days has shrunk rapidly down to around about 35 days now, 36 days to complete a sale. Shows you how people will move when there's that taxation benefit to be found. Whether that stays that quick is to be seen. I think we believe it won't necessarily tick back up to where it used to be. The market hopefully has got used to the idea of being quicker in its activity between point of acceptance and through to completion. But certainly it gives you an idea as well of how much of an influence that has had on that broad market in terms of the behaviour. So a really crucial indicator to consider, though, in terms of the future of pricing and performance in the UK is actual construction activity and how many new homes are being built. So this shows you the position across England, and so the government sets a target in England for 300,000 new homes, and that's represented by the grey bar running across the top of the chart there. Now, for pretty much 30 years now and counting, we've failed to reach that target, and that's been a perennial issue in terms of creating an imbalance between demand and supply. We build around about 150 to 200,000 homes per year in this country, and that serves to really underpin price growth going forward. It's a real issue for the housing market, and it's not one that we expect to see go away. So our forecasts show that we expect to see 1 million homes built in England over the next 5 years. Sounds pretty good if you think about it in big, broad totals, but the target for that next 5-year period would equate to 1.5 million homes, so we're still falling short by about 500,000 homes. If we think about that in a London context, I'm going to turn to talk about London much more in a second. London sets a target for 52,000 homes, and again in London we fall even further short actually than that kind of ratio of around about 2/3 of the target being met. In London we build about 20,000 homes on a good year, and actually our forecasts expect less than that, and I'll come to that now. First of all, though, I wanted to quickly talk about London price performance. So if you cast your minds back to the start of the presentation, we saw how strongly the UK as a whole had been growing. The UK had seen price growth peaking up at around about 13.6% through the last 18-month period. It's slightly dropped back as the chart showed on the UK front, whereas London hasn't reached anything like those kind of levels through COVID. London's actually been, on a regional basis, it's seen the coolest price growth throughout COVID. Nonetheless, it has seen price growth through that period, just much more in the order of a kind of a 4-5%-ish range. And actually, but the signs are that things are ticking up in London, and London is actually now seeing price growth in the order of around about 7.5% and rising. Now, why is that? Some of that is to do with the fact that the cities across the UK and again across much of the world, much of the Western world in particular, saw a contraction in activity in our major cities through COVID. As lockdowns occurred, people either left the city to perhaps go back to family homes, particularly those that were in more flexible forms of lifestyle, young professional renters or students. They went back home. Cities generally saw less activity going on. Now things have changed, obviously, things have reopened and cities are bouncing back now, and London probably is leading that charge in the UK, but indeed many of our big cities in the UK are starting to see price curve lines going up. So the signs are positive for London. I mentioned though about the construction story in London and how we failed to deliver what we need. We're falling more than half short of the targets we set. There's actually some concerning signs in terms of delivery of additional homes in the capital that's going to really exacerbate that situation, and we're going to fall further short. Now this shows you new homes that have been started, new construction activity across zones 1 and 2, so really at the heart of the capital. And what you can see there is there's a worrying fall in terms of new starts in those real central urban areas. A 53% decline, in fact, since pre-COVID through to now. So less and less activity is being started in the heart of the capital, and that in turn is leading to an overall reduction in the number of new homes being delivered. As we do know in London, there are many big schemes that have additional phases to them. So at any one time, there are something in the order of 30 to 35,000 homes under construction in London. That doesn't mean, though, that we deliver those per year. That's just the rolling total. But even the rolling total is coming down, and we've seen a 12% decline in that. So actually, if we go back to what is our forecast for construction completions in the capital in the next 5 years, we're expecting something in the order of 15 to 18,000 over the next per annum over the next 5 years. So we're going to get further and further away from that total. There's going to be less and less availability of homes to buy. Homes that are available to buy in the very heart of the city are going to become even more in demand, and it's going to be something really almost a more hot property than before. So it's one to watch, and it's going to really drive behaviour in the heart of the capital. So what about London as a whole, though? What do we think about the London outlook? So at JLL, we have a cities research team, and they undertake research into 600 cities across the world, and they analyse a whole range of indicators for those 600 cities, a total of about 40 different indicators. And from that, they construct effectively a concept of which cities fall into different types of groupings, different types of rankings. In terms of London, they have London falling into what they call the world 7 cities, the 7 established cities, and these are the 7 powerhouses of the global economy. So London has remained in that group throughout COVID. They're very positive, the cities research team, about the outlook for London, and they rank London top or very highly in a few key indicators. And as we show on the slide here, first of all, they have London as one of the world's most transparent cities. It's a real open and inclusive place to do business. The legal system is easy to understand. The language helps. The taxation system is clear. It's a place that is open for business. Now, in terms of talent, London ranks number 1 of those 600 cities, and that's because we have 5 of the world's best universities, top 100 universities ranked. The top 100 universities are located in London, so 5 of that top 100. So it's obviously a good place to grow talent, but London also does well at retaining that talent. So there's a really high graduate retention rate for those people coming through those universities, and that's largely because London ranks really highly for innovation as well. So London is a place that creates new opportunities. It's the financial capital of Europe, the digital capital of Europe, the cultural capital of the UK, the tourism capital of Europe. All of those different hubs, different industries being in one location creates opportunities, and particularly as different businesses are starting to cross-fertilise, if that's the right term, through technology. Things like the rise of fintech, technology and digital coming together to create new ways of creating opportunity in terms of innovation and a place to work. And fintech was born in London as a result of the fact that you had the digital hub and the financial hub so close to each other. And that's not always the case in other parts of the world. If you go to the US, for instance, their financial capital's on the East Coast, in New York, where the digital capital's on the West Coast in San Francisco. Other countries differ still in that respect. So London has got a very good platform to grow, and we firmly believe it will remain a global powerhouse. So what about the forecasts? It's always a difficult thing to forecast, I'm sure you'll appreciate, and obviously the past 18 to 24 months have really brought that into focus. It's been one of the most uncertain periods. We actually reforecasted twice through the period, given the way the market changed. It was necessary for us to change from that initial outlook where we actually expected a contraction. And we've been really positively surprised by the buoyant behaviour in the housing market and how the housing market has reacted. And actually, we only see further positivity from here. So I just want to talk you through how we construct our forecasts, though. I've sometimes described it as a little bit like art meets science. In the science sense, we plug in a whole load of economic indicators to help us to produce a model that underpins the overall house price numbers that we derive. We then go through a layer where we draw upon the expertise of the extensive network that JLL itself has, and we draw in local expertise who understand what might be about to change in any given market, something that, for instance, an economic model can't capture. And so in a sense, what we bring together is the local knowledge with the economic numbers. In terms of the economic numbers, though, one of the things that we draw upon is the consensus position of the Her Majesty's Treasury's regular forecast that they produce, which brings out 30 professional forecasters' views on the outlook for a whole range of countries. So what the countries we've got shown on the chart here, many of the advanced economies across the world, and what you can see crucially about the UK is the UK is expected to grow the strongest in the eyes of that 30 consensus forecasts over the 2021 and 2022 period. One of the key reasons for that, of course, would be that the UK also saw one of the sharpest contractions through that period, a fall in GDP of 9.9%. So it's actually, to some extent, it's a strong contraction with a strong bounce back thereafter. And that's largely to do with the nature of the UK economy. It's a service-based economy. It's an economy that relies on the ability to do face-to-face business, to get out there and to go to market, so to speak. So obviously, when lockdown happened, that shut the economy down. Now it's obviously now reopened. We're starting to see strong business starting to reoccur, and the UK is growing strongly. Now, we also do, though, take into account a whole range of other indicators, specifically using Oxford Economics. So Oxford Economics is one of the world's foremost economic forecasters, born out of Oxford University. And we particularly look at 6 key indicators in producing our forecasts. GDP, bank rate, unemployment, inflation, earnings growth, and the exchange rate. Picking through some of these numbers that you see in front of you, I want to look first of all at the bank rate. So I mentioned before, the market is being driven by these young professional households who are essentially climbing the ladder, but have seen that kind of solid wage growth, now have some decent housing equity to put into a potential new purchase, and crucially, a very low cost of borrowing. And we do expect to see the base rate start to rise again, and the Bank of England's Monetary Policy Committee actually caused a bit of a surprise in their most recent committee meeting earlier this month, when they actually didn't increase the base rate. It was expected that they would. Currently, it still remains at 0.1% as a result, but it's quite well. It's quite a well-held view now, though, that the base rate will start to rise again, and Oxford have it getting to 0.2% by year-end 2022. Obviously, that's an important point to note through these forecasts. These are all starting at year-end 2022 through to year-end 2026, so you're kind of casting yourself forward 12 months for the very first numbers you get to. But that base rate is expected to rise steadily through that period up to 1.2%. But actually, to put some context around that, that's still an incredibly low cost of borrowing in a UK historic perspective. The long-term average rate of base rate in the UK is 5% since the Bank of England started setting base rates in the late 1600s. So really cheap. And in fact, the previous low prior to the global financial crisis was 2%. So we've seen an incredible era of low cost of borrowing, and that will continue, therefore, to help to buoy the market for those households I've been talking about. In terms of unemployment, there's going to be a lot more confidence coming into the market. It's already a confident market, but unemployment has remained low. It's been one of the success stories of the COVID response. It had been previously expected to get up to 8-9%, but actually has remained low because of the furlough scheme, and actually is expected to continue to tick down over the next 5 years. There are a great deal of job opportunities out there. I've often referred to the fact there are about 1.5 million people unemployed in the UK currently, and there's actually about 1.5 million vacancies. It's just that those two numbers don't necessarily align as perfectly as they could because of the nature of the vacancies and the nature of the skill set of those that are unemployed. But there is opportunity out there, and it's going to continue to see the unemployment rate come down. Inflation is one of the big storylines, as we know, in the mainstream media at the moment. It's one of the concerning indicators. Inflation right now is higher, obviously, than the number you see on the slide there. The Office for Budget Responsibility for the UK says it tracks it at around about 3.1% currently. Other analysts have reported something in the order of 4.5%. The OBR expects it to peak at 5.4% in April 2022. But crucially, all analysts have inflation coming down over the relatively short term, over the next 12 months. It's considered to be a short-term spike, and it will come back under control. It's a view that we also hold at JLL, and it's expected that inflation will get back down around the kind of the target rate of the UK government of just around about 2%, which meanwhile means that earnings growth is going to be considerably higher than that inflationary position. We're going to see some real wage growth across the economy, something in the order of a 3% average. This will also serve to improve that confidence position and helps to underpin that overall profile I was talking about that will drive the mainstream market, a more confident, relatively speaking, affluent families going out and looking to find those homes. Finally, the exchange rate, in terms of interest for international buyers, we do expect to see some currency arbitrage opportunities over the next 5 years, relatively modest by recent standards. The pound to the US dollar is obviously slightly below that 1.440 level at the moment, and it actually did contract slightly on the news that the base rate was being held after the Monetary Policy Committee meeting recently. But something in the order of maybe a 5% currency arbitrage opportunity could be seen over the next 5 years for international buyers. It's perhaps not what has been as interesting to international buyers, though, in recent times. Turning to the actual price growth forecasts, this is the bit I guess we're all really here to hear about. First of all, on the left-hand side is our UK house price growth forecast for the next 5 years. The middle shows our London-wide house price forecasts, and then on the right-hand side there is our prime central London house price forecasts, those real central core golden postcodes one of which is where we find ourselves standing now, W2. If I kind of walk you quickly through all three, first of all, the UK as a whole, we expect something in the order of a 4% average price growth over the next 5 years. So we were looking at incredibly strong price growth in terms of the first chart. There is going to be a cooling effect. And actually, as I started to illustrate with the London numbers, there is a reversal of sorts between the regional strong performance and the citywide slightly cooler performance. It's going to go round the other way now, and actually cities we expect to perform more strongly, and they're already starting to show signs that they are over the next 5 years. So our strongest price growth in terms of large market areas is in London, Birmingham, Edinburgh, Manchester, the big cities of the UK. In terms of prime central London, prime is expected to be our strongest market over the next 12 to 24 months, with price growth of around about 7.5% over the next 12 months. Now that is particularly driven by two factors. One, the real acute shortage of supply, as we were starting to show around what's happening in zone 1 and 2. There are less and less available opportunities to buy in prime central London, and that's only going to get worse. And secondly, the effect of the international demand that has existed for London for quite a long time now, to a certain extent, has been pent up and has yet to be released. And actually, this has been a storyline that's been building through pretty much, if you go back to the Brexit vote in the middle of 2016, there's a lot of strong demand. We at JLL, we see this through our international network of offices. There's been a growing number of high net worth individuals throughout the world as the world has effectively actually got wealthier through COVID. And yet that release valve was actually, in terms of that demand coming to London, was curtailed when COVID meant that travel restrictions were put in place. Now that's obviously reducing. The opportunity to go back to doing international business is becoming more available, and that's why we expect prime to see that really strong bounce back over the next 24 months. In terms of rental growth, rents have been growing really strongly over the last 6 to 9 months, but that's actually the second half of the storyline. The prior period to that, the 6 to 9 months before that, they contracted quite sharply as well, and that goes back to what I mentioned around many people with an element of flexibility to their tenure left the cities in particular. They left cities, and that led to a real contraction in rents. It's growing again, and that's testament to the fact that people are coming back into the cities, and we're seeing real strong price growth in certain sub-markets of London, 15-20% in some sub-markets at the moment. But as I say, that does come off a sharp contraction. Across whole bigger market areas, such as the UK as a whole, or London, or prime central London, we expect rents to start to revert back towards historic norms. Over the long term, rents across the UK as a whole have typically grown by 2.5%, something a bit between inflation and earnings growth typically, and we expect that to become the case going forward. So from here, in 12 months' time, we'd expect UK-wide rents to have grown by about 2.5%. In London, we expect stronger growth as a result of that bounce back that we're seeing, something more like 4% in the next 12 months, the continued return of people to those areas, to those places that they really want to be again, to get back into where the opportunities are and where the opportunities in terms of work are, or cultural hubs, leisure hubs, things that people have actually had taken away from them through COVID that they want to get back again. And then finally, prime central London, we expect to see particularly strong rental growth as well, which is also partly due to that exacerbated shortfall of supply. It's not just a shortfall of supply to buy, it's also a shortfall of supply of opportunities to rent. And indeed, some of the interested parties in prime central London are also considering whether renting is an option for the short term before they decide to buy. So we do expect to see a sharper bounce in rental growth over that period. But overall, netting out at something in the order of 3% per annum rental growth for the next 5 years. So I think that probably gives you a pretty good summary of what we expect to happen over the next 5 years. I guess wrapping up on a kind of a why buy now kind of summary. As you can see, I think we expect strong price growth, house price growth in those key central markets, in those key hub areas such as prime central London. This is because of the rise of the cities again. We've seen cities have had their tricky times through COVID, but as things reopen for business, people want to get back into those vibrant communities. Perhaps demand has slightly altered, though, in a nuanced way. People want to what they now prize is the ability to live in what you could call urban villages. People want to be in areas where they can access some of the great things about rural life as well, a sense of community, access to attractive locations, but also they can enjoy the hub of the feel of the buzz of the city, the bars and restaurants and things that exist there. Now, other reasons why buy now, as we've said, the interest rates remain low, and they will continue to remain low, certainly by historical standards over the next 5 years, and that's something we can be confident of. There's also going to be that real acute shortage of supply, particularly in central locations, and that's going to continue to underpin strong price growth. And frankly, opportunities are going to get fewer and farther between. So now is a good time to buy if you're looking, if you're already interested. Time is now very much. And finally, rental growth. Rental growth is strong right now, and it's expected to remain strong, and certainly to remain well above historical norms over the course of the next 5 years. So it helps to underpin the overall reason why now could be a good time to buy if one of the motivations for the purchase was to consider perhaps a buy-to-let objective for that. So that's probably everything from me. I will be hanging around after the presentation and happy to talk about any of this if anyone wants to. I'm going to hand back though to Alex, who's going to talk a little bit more about West End Gate.
Thank you. Thank you, Nick. I'm sure everyone agree after the challenges we've had over the last couple of years, everything is looking very, very positive indeed. I'm conscious of everyone's time. I just wanted to give you kind of a quick overview of West End Gate. West End Gate is one of our most successful prime central London developments. It's a landmark development for the area, and it's a shining beacon in regards to the regeneration that's been occurring between Church Street and Marble Arch. It's an absolutely fantastic development to be in. It's walking distance from both Paddington Station and Edgware Road Station. It's also walking distance to some of London's most golden postcodes, including Mayfair, Marylebone and Hyde Park. Testament to its success is the fact that we've only got around 40 apartments left. This is a selection of some of the apartments that we've got, but we've only got 40 apartments left between the two phases that are currently for sale. Westmark Tower, which you're currently sitting in at the moment, which is the iconic 30-storey tower, and Asquith House, which is one of the beautiful mansion blocks that sit next door. But as I said, we've got a fantastic selection of apartments left. Manhattan starting at 759,000. 1 beds from around 950,000, 2 beds from around 1.5 million, and we've got a selection of 3 beds, 4 beds, and 2 fantastic penthouses as well. Obviously, 5-star amenities. You're in one of the amenities at the moment, the cinema, and I'm sure you could all imagine sitting in this private residence cinema, enjoying a film or a sport event. We also have 24-hour concierge, meeting rooms, dining rooms, residence lounge, swimming pool, gym and spa. So absolute 5-star amenities. We've got a really good selection of show apartments here. I'm just going to show you a couple of typical apartments, but this is apartment 119.6. It's a 2-bed on at 1.64 million. It's up on the 19th floor of Westmark Tower. A stunning 2-bedroom show apartment. And here is a 3-bed apartment, apartment 1275, which is on the 27th floor of this building. A 3-bed apartment on at 2.474 million. But as I said, we've got a selection of show apartments here to see. So if you haven't been down here before, please take the time while you're here. My colleagues from JLL are dotted around, as are my colleagues from Berkeley. They'll be happy to show you our selection of show apartments and take you across the amenities and show you a little bit more about what Westmark and Asquith and West End Gate is about. So I'm conscious of everybody's time. We're all going to be dotted around if you'd like tours of the development. And as Nick said, he's here to answer. He'll be in the lounge in a second to answer anybody's questions that you may have regarding the forecast. But thank you very much for your time. Thank you for coming, and enjoy the rest of your day.